It is high noon here on the West Coast, which means it's 3 o'clock on the East Coast. And Lance, you're probably getting ready for dinner in Virginia, right?
Well, I'm not that old yet where I eat at 3, but I would if I could get a discount. I'll tell you that.
There you go. Well, it's high noon here on the West Coast, 3 p.m. On the East Coast, and anywhere in between. We're glad that you guys are all here on the CU Digital Town Hall. This is can you believe it? Number 51. Who would have imagined this would last like the whole year long? And then next week, you guys got to tune in next week for number 52. John has some special guests lined up for our anniversary show. Can't wait for that one. But hey, we got a pretty good show today, I think. So, but I want to go through our sponsors real quick first. The fine folks at CUNA Councils. Thank you very much for your support. You guys put on some great conferences year round, and can't wait to get back to the live in-person one. So hopefully that happens later this year and into 2022. And then the fine folks at Correlation. Actually, Correlation is right down the road from me here in San Diego, doing some great stuff with core processing for credit unions out there and their open architecture and all the really cool things that they're doing, again, with core processing. So thank you for their support. And obviously, CU Broadcast, we're here every week with John, just helping spread the word, promote the webinar, the broadcast, and yeah, so much. It's a lot of fun to be a part of this. And then obviously the fine folks at Best Innovation Group. So glad thanks again for everyone's sponsors, and glad everyone can be here to check out today's episode. And again, there's John and me. We are your host. Actually, John has always said I am his Robin to his Batman, and I'm okay with that. So we'll continue with that. But we look forward to many more shows of these, and they've been really compelling. Some of the conversations, like a couple weeks ago or a week ago, when we had the whole conversation about Bitcoin and crypto and how that whole thing works, that was just mind blowing. And all the other shows we have this past year. So hopefully we'll maybe do like a cool little highlight show or something like that here in the next few weeks. But anyway, that's us. And the next one, we have a special guest today, Mr. Lance Noggle. He is CUNA's Senior Director of Advocacy and Senior Counsel of Payments and Cybersecurity. And Lance and I, we've had some really good interviews over the years. And when I had this chance, like, oh my gosh, let's get Lance on, because obviously the GAC just happened. And then Glenn Sarvati is with us as well. And he was just there a second ago. Glenn, he just disappears when I introduce him, but I'm sure he'll be back. But there he is.
I'm here.
That was good timing, Glenn. Thank you for that. But you and Lance, and then there was like Chris Odie, and then you had a whole bunch of folks doing a payments session, and then you and Lance did, and Chris Odie did a Fintech regulation session at GAC. So we're going to kind of do a quick little highlights of that, and then maybe talk about some other items on the docket here if we have some time. But first, I mean, the big news right now, I think probably everyone has seen that the House passed the COVID relief bill today, and it's on the way to the president's desk for signing, which probably means more deposits for credit unions. How you liking that one, Jonathan and Tom?
We could probably do without the deposits right now, but we're not gonna say we don't want people to be helped. So,
right.
But certainly from a balance sheet standpoint, it's not great to pile on more deposits again.
Yeah, I hear that. Tom,
don't look the gift horse in the mouth.
That's
we've had years of very slow growth, and now all of a sudden it explodes on us.
Exploded, I know. Remember, I think it was like this time last year at the GAC, people were talking about, gosh, if we can just get the deposits going, the loans are great. Gosh, if we can just get the deposits going, all of a sudden, be careful what you wish for. It's deposit mania here. So anyway, I just thought I'd throw that out there. If anybody had any comments on that, great. If not, I want to dive into kind of the GAC session recap with Glenn and Lance here. And if you guys want to please chime in, I'll get the chat here as well. Hang on a second. I apologize. And so, yeah, if you have any questions or any comments or like that, just throw them in the chat, or just give us a signal and we'll let you join in. But the first one I wanted to talk about was the regulating fintechs in today's banking marketplace. And Lance, I just want to, what were some highlights for you? I mean, you were obviously a participant in that session, and Glenn did a great job facilitating. Actually, he was kind of almost a referee between you and Brian Lauer there for a few minutes.
It was fun.
Well, yeah, well, Brian was attacking me, so I felt that I had to stand up to him. So no, just kidding. Yeah, Brian's a great guy, and I thought we had a good session.
Yeah.
It was sort of interesting. We had kind of a 3 prongs to it, where Brian kind of talked about some of the legal impediments to credit unions investing in fintechs. Obviously credit unions can invest in a QSO or lend money to a QSO, but investing in certain organizations, depending on their ownership structure, is more difficult. So Brian had some good thoughts on that and how we might pursue some additional authority within CUA. I mean, some of the concern is that you may see an innovative company out there, and a credit union or group of credit unions might want to invest in there to be one of the first to use our product, invest in that company. And it's very difficult at this point for credit unions to do so. And there might be opportunities where credit unions want to work with the community bank or something like that, similarly placed financial institutions, in size and scope, and it's hard to do. So just kind of looking at ways where we might be able to change the regulations through NCUA to do that. The issue I talked about is kind of the threat of fintech. And the threat coming from the regulatory side that we're starting to see here is the Office of the Comptroller of the Currency, the banking regulator, the national banking regulator, has been kicking the tires, chartering a few. Actually, it's more so with the crypto banks, but also looking at some fintech type companies to be national banks. And one of the advantages that these companies could have is, if they're a national bank, is that they can bypass some regulations. You think of, like, why would you want to become a bank? You're going to be subject to all sorts of regulations.
Right.
But if you're a bank that doesn't take deposits, you might not be subject to regulation from the FDIC. And if you're doing lending, you might not have to register as a lender, in the states that you're lending, because you have national preemption. So there's some interesting things there. By the way, I saw that SoFi just bought a bank.
Oh,
so,
good for them.
Yeah. So the social finance company, I'm not so sure I understand that, will soon be bringing even more competition to our members. So that's an area, right? Lots of competition, and trying to make sure that when these companies call themselves a bank, that they're subject to all the same requirements that a bank has, that they're not able to use the charter. And last, Chris Odie talked about working with the fintechs, how the various fintechs out there that want to partner with credit unions and help them provide services or enhance the services that they do provide. So did I cover it all, Glenn? Glenn moderated.
Yeah, I thought Chris had a really nice way that I really enjoyed of, kind of putting the fintechs into 3 different buckets, because we've had that kind of, friend or foe argument for so long. And he talked about the fintechs who want to eat your lunch, the ones who want to sell you lunch, and the ones that want to have lunch with you. And it feels to me like we're definitely moving in the direction where there's far more that are kind of going into those latter buckets of collaboration, as opposed to the flat out kind of confrontation. And I think that's to the best of everybody. There's obviously examples that are out there that, when someone goes directly to the customer, to the end customer and the consumer, that's going to create friction. But I think there's plenty of opportunities to meet in the middle.
No doubt. Yeah. Go ahead, Lance.
And I was going to say, our concern is the ones that want to eat your lunch, keeping them on a level playing field. I mean, that's always our concern with any sort of company that's offering some sort of banking type service, financial service, is that they're subject to the same regulations for that service they're offering. A lot of times they come from consumer protection. So we want to make sure that they're not able to skirt those. So.
Right. And there was a term that you said something super interesting in this one, Lance. A lot of fintechs are threading the needle to get a bank charter. And you mentioned SoFi and Walmart in there. So can you expand on that for the folks listening today?
Well, and there's one that we've looked at in particular. It's called Figure Bank. They applied for an application with the OCC, and they haven't been approved as of yet. But we're actually contemplating with our friends at the American Bankers Association and the independent community bankers suing the OCC over this one. And this is a company that's developing a bank. They want to lend money and do most banking things, but they're not going to accept FDIC insured deposits. Although they're going to accept deposits that are uninsured, and only available to accredited investors. And so accredited investor has no meaning in the banking world. It does have a meaning in the securities world, right? It's like a high net worth person who can buy a hedge funds. Unfortunately, that's not me. So they would, by becoming a bank but not accepting FDIC insurance or not accepting FDIC insured deposits, they could cut off a bunch of regulations that come from the FDIC that every other bank has to comply with. So they would get the protection of this federal charter, not, again, like I mentioned earlier, not having to comply with state lending rules, maybe money service business rules, maybe be able to hold crypto, all sorts of different things that they would be able to do and keep the states away. But then they would still accept deposits uninsured.
Wow.
And avoid things like the Community Reinvestment Act regulations for lending, meaning they could just go lend to whoever they wanted to. They could red line and do all sorts of stuff that a bank couldn't do. So what some of these fintechs do is they have, they go about operating their business a different way. They get some Silicon Valley seed money, if you will, some VC money. They hire some pretty smart attorneys and some consultants and figure out how they can develop this product, avoiding the most amount of regulation. And then you can offer products either easier to offer them, or cheaper, or both than a regulated financial institution like a bank or credit union could, thereby helping yourself grow. Or this is my other way I think they work, is that they don't care if they make money as long as they grow, because that's what their evaluation is going to be based on.
Yeah, exactly.
So
you also mentioned in there, and Glenn, you can comment on this as well. It's like there was a term in there, rent a charter. So can you expand? Can you talk about that? Glenn, I'll let you go first on this one.
Yeah, sure. It actually kind of ties back to some of the stuff Lance was talking about before, where some of these newer, quote unquote banks really aren't banks in the literal sense of the word. Things like Greenwood, it's popped up recently here in Atlanta, Daylight, New York. There's several of these and they're very careful. It kind of gets back to Lance's point of threading the needle, so you don't wind up running afoul of technical disclosure.
Yeah.
They're not banks. They're basically front ends that are actually leveraging the charter of a partner bank. But at the end of the day, I think the average consumer has no idea. Now, you can argue, does it make a difference to the average consumer if they still have the same protections?
Right.
It's not coming from the party they're engaging with. It's coming from somebody behind the scenes. I mean, you can go back to Simple. Simple was the same approach. Going to a different organization that stood behind the scenes for them, and then they got acquired by BBVA, et cetera. So I think that's one of those interesting cases where, that may be where we're heading. And it just feeding off of something else that Lance said in terms of, the point about FDIC insurance, I think it really starts to muddy the waters. I think, I bet if you asked 90+% of people, bank equals insured deposits equals FDIC. There was a great point that I thought was made at the advocacy breakout session with Ryan Donovan and Richard Gose, where based on some research, the messaging still, the average person, I don't know, but the perception is still not fully understood. The FDIC has much better brand equity than the NCUA. People know what the FDIC is.
Oh, big time, yeah.
They don't know what the NCUA is. And according to the research that they had shown, there's still about 30% of Americans that don't realize that credit union deposits are every bit as safely insured as bank deposits, which obviously is going to create a challenge if you're trying to go head to head against a bank. So, it's kind of interesting. I don't know that's going to happen when you're talking about a rarefied world with accredited investors and whatnot, Lance, but, you could argue that, they may be doing themselves a disservice on the banking side, which maybe is one of the reasons the ABA is now crazy about it, because they could break down, you could deteriorate that automatic connection between bank deposits and insured deposits. I'd rather be focused on us building up the awareness that credit union deposits are insured deposits. That was one of my big takeaways from one of the other sessions as well, to kind of bring a couple together.
Yeah. So there's another message to get out there for credit unions to hammer home. So go ahead, Lance. I'm sorry.
Well, I was gonna say, just to build on what Glenn was saying, is like, we don't have any vested interest in seeing, the bank charter diminished for those reasons. I mean, they're competitors obviously, but they're still depository institutions. So adding additional confusion to the protections you get, I don't think it's really good even for us, even though we do compete with banks. Now, I was going to add one thing to the Renta charter.
Sure.
Is the other thing you see is like the Google checking, where they're going to have this Google branded product, yet on the back end, instead of just having one financial institution, it's going to be a plethora of financial institutions, credit unions and banks connecting into it, or but where you're going to go to your Google pay app, it'll search up some financial institutions, and you'll figure out which one you want to join or use, but it'll look the same no matter which one you use. So that's kind of not exactly like the Renta charter, but sort of kind of another flavor of it.
Gotcha. Now you guys mentioned Chime as well. Is Chime kind of in this category as well, or where are they fixed? Because it sounds like they actually like partner with banks to provide the services that they offer. Is that a correct assumption, Glenn?
I'm trying to recall. Do you know offhand, Lance?
No, I think
somebody mentioned Chime.
I think that might be right, but I'd have to look.
I'll have to go back on the video and do a replay. Sorry for the curveball. Hey, also getting back to the fintechs part of it, Chris had a really good point, because he looks at it from so many different angles. Obviously, from his CU 2.0 perspective, from his board, he's the board chair at South Bay Credit Union. And obviously he's a credit union member, but he said he looked at it from the board culture and working with fintechs. And he kind of named off a lot of the type of folks that are on his board. And so that could either help you or hinder you in working with fintechs if they're open to partnering. So what are your thoughts on that, Lance?
Yeah, and I think he even coined a term that I had heard before, like the chief fintech officer, or something like that he recommended, that basically credit unions have somebody that's pointed to lead that strategy. So I think he made some valid points. Moving forward, you're going to, and maybe we give too much credit to the term fintech sometimes. You're just looking for like a partner to help you provide services. And you're probably going to need a partner for some of these services or products that are more innovative and require more expertise. But I think his thoughts were, if you got your board focused on it, had that person with someone in that title who's a point person and who now feels empowered or responsibility for finding, working, vetting fintech partners, that could help push a credit union along the way.
Yeah, no doubt. And because I heard somewhere that there's like 16,000 fintechs out there, or companies like that are marketing their services to financial institutions out there. So can you imagine the shiny red ball syndrome that a lot of credit unions are going through? I'm sure Jonathan and Tom, you guys probably go through that on a daily basis. Like all these people probably just knocking at your email door, like, hey, can we work with you? Can you work with you? And so I'm going to get with you, Jonathan. I'll let you go first if you want to comment on, like, how do you guys decipher or filter who you guys want to work with in this area?
So, we've started to, the amount of LinkedIn spam that you get from these types of companies and organizations is pretty crazy. And what we've started to do over the past year is, because there are so many of these startups and fintech firms, coming and going every day, we decided to take the approach of signing and becoming a member of MDC, the Members Development Company. And that's basically our vehicle now of really trying to help decipher and evaluate different fintech partners in regards to using some of their research and resources in evaluating, does it make sense to partner with some of these different smaller startup organizations? And it's interesting. We've definitely found some good partners going that route. We're looking at a couple right now that I think are going to become very beneficial for our organization. But to your point, Michael, you do need people or resources to help you filter out the noise, because it's too much to do on your own. And, we don't have just a big group of people focused on, partnership opportunities. So we needed to leverage outside help basically to do some of that.
So Chris Odie might be right about having a chief fintech officer to kind of filter out all these folks. Tom, what do you guys do at your credit union?
Yeah, that's like the role of the chief technology officer, really expanding that to include these fintech or other technology companies. But I think at first it just starts with the credit union strategic plan. So where are you in your technology curve evolution, and what do you need to do next? And then you can filter out all those shiny objects that come down that really don't work for where you are in that evolution. Mm-hmm. But just like Jonathan said, our QSO, Member Support Services, has been helpful in us in then further vetting technology providers that we've looked at. We've had some experiences through the QSO where we have somebody that looked really, really good, really cool on paper, but that's about it. Mm-hmm. Their execution, their ability to hook into our core system, which is, as it's very flexible. Oh yeah, was just non-existent. So one of our partners had a really bad experience, and we just, we walked away from doing anything further and said, come back when you're ready for prime time. It's really, for credit unions, it's really got to be a collaborative effort, because there's no need for all of us to sit here and repeat the same things over and over. Yep. Looking at collaborative groups is an excellent way to help filter that out, and make sure you're focusing on those that are going to support your strategic direction.
Exactly. Yeah. So you could call Jonathan can call you and say, hey, what do you think about these people? Have you worked with them, et cetera, et cetera? What have you heard? That type of stuff. Yeah. That's the beauty of credit unions. Oh my gosh. Mm-hmm. You guys can talk to each other day in and day out about this type of stuff. So there was another term, this is kind of my last one on this session, but there's another term that came up each time often in this session, and it was regulatory arbitrage. And you mentioned it, Glenn. So I want to start with you on this.
That's been one of my favorites going back in time. And I think it kind of, again, speaks to what Lance is talking about already, whether it's, it can be an existing, chartered financial institution. It can be somebody new, charter shopping, you've got all, I forget what the count was. I think you might've given it at one point, Lance, the number of different regulatory authorities that you've got to navigate in the US between the state charters, the CFPBs, you've got, you can go with the OCC or, a national charter, state charter, whatever. As we've seen, particularly recently with the OCC getting very aggressive around their approach to blockchain and some of the new technologies. And, it becomes, let's just find the easiest path. Where am I going to get the least resistance? Where am I going to get the most latitude? Either that's where you cast your lot in the first place, or maybe you change your lot along the way, which is not unheard of either, although it's a little bit tougher. And I think that's I think what Lance is talking about as well, is trying to get a little bit more consistency across the different regulatory authorities, so we can at least understand where everybody's what playing field they're on.
Mm-hmm. I was going to say, I think there was 100 or so by the time you incorporated the state the state regulators. Just trying to navigate. I asked any of you this question: who knows why the Federal Reserve regulates a bank as opposed to the OCC, as opposed to the FDIC or the state regulator? Like, it's almost our European brother, and then you add in the credit unions, right? Like our European regulators look at it and wonder what the heck we're doing. Mm-hmm. And sometimes I do too. CFPB, all sorts of stuff. So you can see why. I can see you can't blame a company for trying to find some safe home where they can have less regulations to comply with, or at least consistent across the board.
Mm-hmm. Does the change of administration, how is that going to impact the regulating fintechs, or just our conversation? Do you see that having a great effect, Lance? I think your eyebrows are raised. So
I would think that would turn up the empower the CFPB to be more active, mm-hmm. As opposed to we're kind of looking at when I was talking about the charters, obviously that's getting a bank charter, but the CFPB has the ability to regulate a lot of these companies as well, obviously for from the consumer protection. Mm-hmm. So I would think that they would be emboldened to be more active, to to look more closely at these companies, make sure that, consumer protection rules are being followed. I mean, they're going to hit us too. So,
yeah.
So,
do you think that gives credit unions more confidence in working with some of these folks, or what do you think from the credit union perspective? Or maybe that should be a Tom or Jonathan question.
Well, I can answer part of that, but I mean, I think that, it depends. I mean, I think talking about the ones that want to compete with you, they're offering the product. So, the ones that are partnering with you, I think they're relying more on the credit, or they're pushing you up front. Now the CFPB can come in the back end and say, hey, what are they doing? Is there some issue with the lending platform that they're selling to credit unions? Or, are they, CFPB could even look at privacy and data security, to be honest with you. So, I mean, they really could, they could do more than they're doing, and I would expect them to do that.
Yeah, indeed. Yeah, Tom?
Yeah, if anything, it's going to make us more cautious because, the CFPB is definitely flexing their muscle. We've seen that already, even under an interim ruler. And NCUA is taking more of a, call it social justice position. DEI, the chair in a recent speech talked about how they did consumer compliance exams and found all kinds of faults and failures of credit unions. And so there's going to be a lot more ramping up of that coming at us. So if we now take on a fintech with a particular shiny object service offering, our due diligence is going to go deeper and deeper than it ever had been. We can't run fast and loose. We can't blame them because it's all going to come back to us. So they're going to really have to tighten up on where they go. And I think that's part of the reason SoFi pivoted too, is they originally went for a charter, wound up spending $22 million to buy a $150 million bank in California. And now we're going to apply, talk about the arbitrage, now apply for a national charter using that and then build their business. So they'll have low cost of funds through a bank, yet have the technology stack behind it to really blow up their business and make it grow.
Wow, what a
and you get a certain level of the infrastructure of compliance that comes with the bank as well. So that is a definite plus for them when they start looking at banking charters, because it's just the compliance and regulatory, it's going to get worse and tighter.
Well, they have to pay for that sponsorship on a certain football stadium that they built out here in LA. So they got to do something to pay for that. So, oh my gosh, what a dance some of these folks go through to get to where they want to go. Oh my gosh. Hey, the other topic that I want to talk about, and all of us have heard about this buy now, pay later trend right now. And I, you guys have probably heard about it 10 years ago. I just heard about it, a couple of months ago. And there's a company called Klarna, I think you guys are probably familiar with, that it's kind of blowing up on the internet. Glenn, I want to get your reaction to this. And then how does it affect, I want to talk to Tom and Jonathan too, what their reactions are and how it affects their operations at credit union. So Glenn, I want to start with you on buy now, pay later trend.
I saw Jonathan nodding already, so I'm really curious. It sounds like he's already seeing the impact. It's fascinating to me because, one of the things we saw over the course of the last year is, I'm sure everybody on this call is aware, outstanding credit card balances have dropped significantly, which is not what you would normally expect at this stage of a recession. But you also wouldn't expect deposits to go up by 20% either. So it's been a very unusual economic cycle. And a lot of that has to do, again, with the stimulus payments and the fact that we've got that, quote unquote, K-shaped recovery. So the people who still are doing okay are doing even better. And therefore they don't have to, they don't have as many places to go out and spend their money. So they're not running up, travel expenses and dining expenses and things like that. So that's one of the reasons that the balances are down. But then you've got this buy now, pay later stuff. And I'm not sure anybody's really parsed out exactly how the two different components, factor into how much the outstanding balances are down. But you've got this logic, and it's kind of fascinating to me because when you really look at it, first off, in my view, American Express has been offering something very similar to this for a long time, which is sign and travel. So it's just kind of putting a new high-tech, different marketing spin on it. And it seemed, particularly in the UK, became a big fascination, especially around the holiday season. And, again, part of the proposition is, Mr. Merchant, you ought to be funding this because it's going to help drive more traffic in your stores. And you can sell more, particularly high ticket, high value items. Isn't that what credit cards did in the first place?
That's what I was thinking.
It's a little, but it's a different twist on things. And in many cases, it's actually turning out from a standpoint from the consumer, it's a fixed flat amount that's owed over a certain period of time. So it's a little bit more like the old layaway plan, except you get the product up front, instead of having to wait for it at the end.
Exactly.
So, but the merchant seems to be willing to fund it. And I'd love to know exactly how much that's taken up, but there was one study, and I forget the exact number, the percentage, but there was a remarkably high percentage of purchases on buy now, pay later in the UK over the holiday season, where now the belief is that people have overextended themselves.
Oh, really?
And there's going to be a fairly significant, percentage that are going to be straining to make those payments. I was really surprised, and I saw a few people online recently whose opinions that I really respect. And I was kind of dumbfounded by this, but I hadn't thought about it this way either. Positioning the whole notion of buy now, pay later as more consumer friendly, which I don't necessarily think of that way. But the logic was, rather than just putting it in my credit card balance and I pay my minimum amount every month and it just sits there and accrues interest forever and ever, and I just never get out of debt. The logic is, I know I have to pay it in 4 chunks of a defined amount over this period of time, and I'm going to be done with it. I don't have to worry about it continuing to roll over.
Right.
I can kind of get that, but you better be sure that you got that money in advance. And I'm still trying to figure out where is that money coming from? Is
exactly. How do they police
what
that?
happens if right now we got 20% deposit growth? So maybe there may be money in the account if you go into the debit to get it. If you put it on a credit card, I mean, you're just going to wind up putting it on the balance anyway.
Exactly.
It was just a way to kind of park it for an extra X months before it wound up in the same place it used to go right up front.
Yeah.
Jonathan, I'm still seeing lots of nodding. You guys look at this. I'm curious.
Yeah, I mean, so it's interesting. I actually went out and signed up for a Amex Blue cash back card the other day because I was sitting there going, it's like, okay, this has got some interesting benefits. I want to see how the heck this thing works. And one of those is this built-in buy now, pay later kind of concept. And we're starting to see it with our members, in chatter about, Amazon offering it, PayPal's doing it, Amex has been doing it for a while. And it's interesting. We've thought about it that same way, where it's kind of, okay, it does seem a little from a overall financial long-term financial health standpoint, it makes sense that you don't want vulnerable members necessarily loading up credit card debt and letting it sit there and just ultimately sink them over the long term and just drawing that out. However, what we're kind of curious about, and we haven't done a lot of formal research into this, but we're kind of wondering, like you mentioned, Glenn, these consumers are using these services heavily to basically, leverage, increase their buying power during holiday seasons and that sort of thing, and leverage that. But how many of them are thinking of this like a credit card and not really remembering that those payments are, you can't adjust that payment. It's coming due, and whether you want it to or not, you can't just let it sit out there. And so, we're kind of curious to see as the next, this year goes on, are we going to see a lot of and I'm not even sure exactly how this works. I haven't really read the agreements with all of these services, but are we going to see these merchants trying to somehow claw back goods and funds for products that these consumers really couldn't afford, yet they sort of treated these buy now, pay later plans as a credit card without really thinking it through. And I think that's the other question that's big on our mind is, how do merchants get made whole again from these plans when you're essentially self-funding them? It's one thing if you're an Amazon, but if the merchants are having to sort of pony up the goods and not get the full payment right away, where does that liability lie? And so while it's definitely interesting, and I can see how people can position this as consumer friendly, I just worry that it's going to put a certain segment of consumers, at least, in a hole that they never really had a means to get out of, like you mentioned, Glenn.
Yeah, it's an invitation.
I would love to.
Slippery slope. Go ahead. Glenn.
I would love to see the agreements too. And maybe you know more about this than I do, Jonathan, because I feel like I should know this, but you're saying something a little different than what I had envisioned, but I don't know for a fact. Who's left holding the bag if the consumer doesn't make good? My thought was it basically worked like a credit card where the merchant was made whole. Maybe they didn't get all the money up front.
Yeah, and I'm not sure.
I thought it was the Affirm or the Klarna, and they'd be the ones that wound up with that risk. Or what I was more concerned about is they'd turn around and just offload it on a credit card. And it would be, the issuer who didn't get it in the first place. Then it wound up being a less attractive balance that just wound up getting dumped on someone else.
Right. And I guess you could leverage it as sort of more float for your credit card balances like that. And, I think it's a very interesting dynamic and one that we haven't seen the full ramifications of yet. And, I hadn't heard about the propensity to do this in the UK, but now I'm kind of curious to see, is that going to come home to haunt them in over the course of this year if it was leveraged that heavily, over the 2020, Christmas holiday season?
Yeah, like a lot of things, it seems. I'm wondering if the UK just may be getting there before us, like tabloid journalism and stuff like that. Because I'm thinking that because of what they're seeing kind of come home to roost, that their regulators may go after a little bit sooner. And, we can maybe just use that as the canary in the coal mine and figure out where it goes from there. You mentioned that you signed up for one. Is it the merchant's option whether they want to accept it, or is there a ticket, a ticket price? It's kind of the floor. It's like, this isn't worth doing for less than $100 purchase. I know things like QVC was a big place.
Yeah,
I know that,
exactly. And what's interesting is that I'll have to investigate it a little bit more. I don't know if there's a floor in terms of purchase price, but this is mine's all through my Amex card, and they actually partner with PayPal too to offer this type of service. Now, the interesting thing with the partnership from PayPal is that you have to pre-fund this Amex Send account with the amount you want to use when paying through PayPal. So it's got a bunch of moving parts, and I'll have to dig into it a little bit more and see what I can find out. I haven't used it myself yet. I've always actually been just kind of hesitant to use it because I'm going, I don't really want to be locked into those payments. Either I'm going to pay for it now or I'm going to use my credit card and get my cash back points and be done with it. But I'll have to look at that because I don't know the sort of minimums and maximums that Amex is enforcing for that split payment option.
It reminds me a little bit even of, auto leasing. I mean, when was the last time you saw a commercial that told you that the car you were looking to buy cost $38,000? You see, it's going to cost you $299 a month.
Right.
Yeah, never.
The same kind of thing that whether you want to call it QVC or whatever, hey, you can buy this package for 3 easy payments of $39.99.
Yeah, you never see the total. Yeah.
Right. Exactly.
I see the smaller number. Yeah.
I don't know if you saw, Mike, we got a great comment in the chat
too. Yeah, you want to comment? I mean, is it Cody?
Cody.
You want to come on and talk about it?
I think you make a great point about how it does actually bring the service provider closer directly with the merchant.
Yeah, Cody, comment on your comment.
Just observation, Mike. I seen this product, the platform called Zest, especially in India. It's very deeply embedded with the edtech space. So retooling the skills. Normally, best example, if you are a system admin, if you want to learn Kubernetes, the new upcoming technology, it might cost $1,500 for you. What this particular platform does, it partnered with the service providers, right? Whoever, like institutions or educational colleges and stuff. And they provide better deals and also give the flexibility for consumer to onboard onto this easy installment way of paying that tuition.
That seems to me like a really good use case. I'm wondering if that's happening more, like you say, in the developing countries. I'm guessing they've got less of a credit culture and probably wouldn't have a credit card necessarily, and particularly a credit line for the types of ticket items that you're talking about. Is it, these are people who wouldn't have another way to quickly make an installment payment program?
Absolutely, Glenn. Yeah, availability of the credit and also prioritizing of using that credit, right? Obviously, most of the folks might be in the transition phase. They want to save the credit line to use on a regular day-to-day side of expenses, where this one is like one-time expense and trying to pay for a career change expense, right? It's a large expense, just like a durable goods, right? Just imagine if somebody partnered with Samsung or Whirlpool for appliances, right? And offering this particular, pay like 5 times or 5 different installments for your purchases.
Yeah, I mean, when I think about it that way, it does make a lot of sense. I mean, kind of the equivalent of, again, a big ticket item, again, something that we would have seen here in the States, like, a purchase you see a lot of times of a mattress or something like that, or, home furnishings. No interest payments as long as you pay in the next, whatever, 15 months.
Days, yes.
So this is the same kind of an approach to that in a more automated fashion and in a kind of a real-time fulfillment.
Yeah, it looks like the Klarna has a couple of plays going on though. So they're buying the paper at the point of sale at a discount, anywhere from 3.5% to 6%. So they're paying $94 for $100 worth of debt. So right there, you're talking, and a 4-month repayment, you're talking an 18% return on your money up front. But they also have an installment credit contract on the back end. So let's say you bought a laptop, $2,000, 4 payments, $500, let's call it. Realize that's a little steep, more steep than you want. They'll put you in an installment credit contract to stretch that over whatever, 6 months, 12 months, 20% in the US, at least 20%. So they're making a far significant return on that when you have an either breakage for somebody that doesn't pay the 4 months, or for somebody that says, look, I want to reduce that payment, and they wind up paying, a pretty steep price for that credit.
Yeah.
But also on the merchant side, they also give them fraud liability, because online fraud for purchases is just crazy. They're rolling that into their value proposition for the merchant. So that's worth a lot of money to some merchants, just handling the thing, let alone the actual losses and whatnot. So it's pretty smart. When you hide anything behind an app, all of a sudden it's cool, and people are it's no longer, it's no longer layaway plan or buy here, pay here. Now it's cool and trendy and hip,
Well, yeah, the financial brand story said this is geared toward younger buyers. So so goodness. Lance, what's the CUNA perspective on this?
Well, I was gonna say, if you're the merchant, you're not even, it's not even a 6% cost. It's because the purchase would be paid on your credit card. So that's 3% there. So it's what, 3%. So it's not bad. Like, it's just another avenue to be able to help someone purchase a product. And merchants hate to interchange anyways. So I can see why it's attractive to the merchant. Hey, look, I just offered another way for my members or for my customers to purchase this item. I think I would expect that we'd see the CFPB looking at this pretty carefully.
I would think so.
As Jonathan mentioned, and it's like all these products that I track for CUNA, it gets difficult because I don't want to sign up for all of them myself. I don't want to purchase something with a firm and have them do a hard credit pull or whatever they're going to do. And next thing you know, I have to go to the car dealer that sells me uses my job as my credit to purchase a car because I have so many credit pulls. So it's hard to keep track of how they're doing this or why it's so attractive. But I was also going to mention, I've seen with my normal American Express on my statements that they're trying to also sort of just put in some sort of special payback for a big purchase that I make, like those installment plans. Build that into my normal bill if you want to do that. So, but I also think, like Lynn said, it's nothing new. If you have a fintech company, you take a name. Here's my theory. You get some normal name. You spell it a cool way. Use a K instead of a C. Do something like that. Get some youthful people in your photos. Market it to millennials, and boom, get some VC money. And doing the same thing that everyone else is doing.
Right. Well, now that you say that, because a couple of years ago, Amazon presented me with that option. I had to buy like a wireless router for it was like $1,000. And so they offered me, hey, you can pay for this in 4 installments instead of the whole thing. And I went, yeah, let's check it out. Let's see what it does. And boom, all I did again for Amazon, I just pressed a button, and then boom, they just took it out of my account, every month, for the next 4 months, that installment. There was no interest, there was no nothing. And that this whole buy now, pay later thing totally reminded me of that. And that was 2 years ago.
I did that. I was going to say, I did that. First time I ever did that was probably in 1985. I bought a lawnmower on a free 6 months financing in my first house. Nothing is new. None of this is new, like Lance said.
Right, you're right.
You can rent a bank charter for the financing part. It's factoring to buy the credit card debt, essentially. And then it's putting it together and automating to cut the expenses out of it and make it as tight as possible.
Right.
Nothing new.
But I want to know, does it impact the credit union's operations, the credit card portfolios? Does it impact any of that? Are you guys nervous about this at all, or is you just business as usual?
It takes money away from us. It's an alternate form of financing.
Right. That's what I was thinking.
And it's nothing we couldn't do if we wanted to either.
Right.
And just looking at it from the interchange standpoint, interchange is constantly under attack. So I think some of these companies, large companies, retailers, Kroger, any of them, they look at that interchange that they pay as just something that they would like to get rid of. So again, they're paying for this too. It's not a whole lot more maybe than interchange, depending on the deal that they have. But yeah, it's moving money, the interchange income away from our members. I think hurting maybe the relationship again. It could be with them. So yeah, and we don't know what consumer protection that they're receiving. These look like loans to me, but are they, how are they being underwritten? I think
that's one of the questions I think that's really important is do they have to go through the KYC stuff? Do they have to prove income sufficient to make the payments? All that stuff that we have to do as part of our lending process. I would imagine these guys are skipping, despite the fact that even if it's a short-term 4 payments, but also when you look at, they get 3 payments in, like Tom's example, they get 2 payments into the 4 and they're, something's come up and they can't do it. So they spread it out over 12 months or 24 months. You've got an installment loan, but none of the regulatory requirements that we would have to make that loan.
That was kind of the magic number I heard in your kind of, for example, Tom, the 20% interest. I know you're just making that up, but as soon as you convert it to something that looks like a credit card loan, and back to Cody's point too, if you got a big ticket item, whether it was the old mattress, or rooms to go or whatever, you buy a big thing and you pay no interest for a year. Same thing for, it's a great deal if you can make the payments on tuition and not have to pay any interest. If you miss the payment and it starts turning into what looked like what would have been a credit card loan all along, I think maybe the question that gets the CFPB's attention is what percentage of them are happening? Is it only a back door to kind of make that happen? And then I start thinking Washington Mutual and service fee revenue or an NSF. You kind of knew it was going to happen.
So I wanted to mention something that, in a slight tangent, that when Kevin mentioned KYC, there's one area where Fintech is cleaning up, is that's on the friction of some of these products. And I opened up an account for my son, for a Robinhood account, so he could buy Dogecoin. If you don't see me again, it's because we made out. But I was shocked. like, I encourage you to open a Robinhood account. I was shocked at how easy it was. And I mean, I don't even know how that they can do it, you know, with the amount of information that they collected, you know, unless my Alexa's stealing my thoughts and transferring it over to them. So, I mean, that's where some of these companies have really, and again, maybe they're circumventing some regulations, who knows, but they make it so easy to do something that, you know, it's attractive.
And yeah, and I will say that's across the board. I've opened Robinhood accounts, Stash accounts, and Acorns accounts, and you know, all of these types of, you know, investment services accounts, and it is, and even the Amex card that I opened recently, it's amazingly efficient and optimized in terms of that workflow and how quickly you move through it. There's very little friction, and you know, I know from our credit union standpoint, that's an area where, you know, we've really been trying to learn from for years, is how to replicate that experience while also adhering to the regulations we have to adhere to, because that's ultimately what is going to make our members more likely to apply through our platforms. And if we can perfect that, then we're going to be in much better shape.
Yeah.
And then by comparison, I mean, just kind of comparing to the last couple of comments, and Lance, you setting up the account for your son. Just before the pandemic, I took my daughter in to open a checking account to the branch. Didn't do it online, did it the old-fashioned way. You know, I already had an account. They knew me. It shouldn't have been a big deal. And we were sitting in somebody's office for at least 45 minutes, if not longer. It was pleasant. I liked talking to them. I knew them. That was fine, but it certainly wasn't a painless, you know, in and out experience.
Yeah. That's a time commitment. Oh, go ahead, Tom. I think you're on mute.
Glenn, were you buying a car? 45 minutes sitting in there?
You know, I have to say, the last car that I bought, which was during the pandemic, was a heck of a lot smoother than opening my daughter's checking account.
Credit unions are notorious for literally shooting themselves in the foot, being extremely conservative and defensive. I was looking at one credit union's website to check out their automated new member joining process. It literally was download the PDF, print it, send a copy of that with your copy of your driver's license, notarized.
Oh my gosh.
With a check in the mail.
Jonathan, you're gonna have to improve that process. Gosh, Tom,
Yeah.
I know, seriously, I gotta go talk to our accounts department.
Didn't want to call you out, but
full disclosure, in this case, it was not a credit union, and it was not really being conservative. It felt a little more kind of sewing circle. It felt more like it was, hey, this is a nice time to kind of just sit around and talk.
So that's what I'm looking forward to with the Google product, right? Because you know that, well, I've talked to them several times, is that they're putting a lot of work into that front end of, they want it to, you're joining it, they have all your information. You know, if you're going to join the credit union, or you're going to join Wells Fargo or whoever through it, that it's going to be, you know, simple. And, you know, maybe, you know, we look at that closely, you know, credit unions outside of that process someone can figure something out like that for them.
That will be fascinating, because I mean, it was a whole year ago now. That was, you know, when we did GAC live in person exactly a year ago, and we had Joe Knopp from Stanford Federal Credit Union up talking about working with them. And here we are a year later, and it hasn't launched yet. And
I think that I mean, I haven't talked to them for a few months, but I mean, they're looking at, they might be, we can talk to Joan Glenn. Joan's on our CUNA payment subcommittee. I try not to ask her about it, but we can grill her on our next call next Wednesday and see where they are.
Yeah, I mean, they certainly haven't gone big in terms of the promotion. And I don't think it's because they're having a hard time. I think it's because they're going to make sure they get it right. So when they go out there, they've got a whiz-bang product.
I think they're piloting it now, is where I think they're at. So,
but I think one thing, you know, from a takeaway standpoint, one thing credit unions should do and have their staff do is apply for these products, open accounts, go apply for a Citibank credit card as a non-customer. It is an excellent experience. I did it a couple of years ago now, and it just it was quick, easy, clean. That, you know, they just integrated the entire KYC process within the whole flow. And then look at those and then compare what you're doing. Break it down. Take screen prints as you go through. Break the whole process down and see exactly how that compares to yours. And then start questioning everything. Like, why are we doing this? Why? Ask the 5 whys to your people about why you're doing it. And there's a lot that can change without putting yourself at undue risk.
That's a really good point.
Good stuff. Yeah, that's a great exercise to do. All right, guys. Well, we got 5 minutes left. Anything else? I was going to get into the whole payments section that you guys at GSC, but don't worry about it. Not enough time, because by the time we get done with that conversation, something drastic will have changed in the payments world, and so it will be all moot. But anything else to add, guys? Any final thoughts here, Glenn or Lance, on the topics that we talked about today? This is super interesting stuff, especially the buy now, pay later stuff. Oh my gosh.
The one thing I will throw in on the payments one, I don't want to take up the floor if anybody else has anything to add, but we had a great discussion, if you've got access to the replays, around real-time payments. We had both the clearinghouse and the Fed, their Fed Now solution. And the Fed Now's got some interesting stuff going on with the pilot that they've now launched with about 100 participants, credit unions, banks, service providers. And that's really good to see, because it means that they're going to, I think, have a much better chance of hitting the ground running in 2023 when they go live. Because that was always my biggest concern was, okay, we're live, and now we got to actually figure out how we're going to use the thing. They've got a much better chance of, already being at a pretty good gallop by the time they open the curtain.
Yeah, and I was going to add, I think
Go ahead, Lance.
listening to them talk, I think we'll see maybe more interoperability. I can't even say the word now.
Interoperability.
Then we thought we might, right, Glenn? I mean,
That's a really good point. It definitely, it seemed before that they were really at loggerheads, and they're not, it's not kumbaya, but they're definitely moving in that direction.
Yeah.
All right, gentlemen. Well, good stuff. Yeah, I highly advise, if you guys still have access to the CUNA GAC sessions, go watch the one on real-time payments. Good stuff. And watch the wrestling match with Lance and Brian in the fintech regulation one. That was entertainment in itself right there. So,
as well as the one that Tom's in with John Best.
That's right.
Burning the boats.
Good stuff. All right, guys. Well, I'm going to let you all get back to work. Thanks again. This is so much fun. Really interesting. Great takeaways. Appreciate the time. And keep up the good work, everybody. All right.
Thank you.
Thank you very much.
All right. Thanks, everybody.
All right. Be well. Thanks again.